Is buy and hold a scam? For decades, the financial world has championed buy and hold as the gold standard of investing. The logic is simple: buy quality assets, hold them long-term, and reap the rewards of compounded growth. It's the strategy Warren Buffett himself swears by, or so we're told. But what if buy and hold isn't the foolproof strategy we've been led to believe? What if, in today's volatile markets, clinging to this outdated philosophy is quietly draining your portfolio's potential? Before you dismiss this as heresy, consider this. Would you blindly hold on to a crumbling business, hoping it will turn around someday? Would you keep pouring water into a leaky bucket, convinced it will eventually hold? In this article, we'll challenge the sacred cow of buy and hold investing, revealing its hidden flaws and exploring smarter alternatives to safeguard your wealth. The origins of buy and hold. The buy and hold philosophy gained traction in the mid-20th century, popularized by economists like Benjamin Graham and his protege Warren Buffett. Their thesis was simple: timing the market is impossible, but investing in solid companies long-term can beat the market over time. The problem? This strategy was born in an era when markets were less volatile, technology wasn't disrupting industries overnight, and holding a blue-chip stock like General Electric was almost a no-brainer. Fast forward to today. We live in a world of meme stocks, rapid innovation, and global economic uncertainty. Buy and hold doesn't always align with modern realities. Fact check. A 2019 study by JP Morgan found that 40% of all stocks in the Russell 3000 index lost at least 70% of their value and never recovered. For these stocks, buy and hold was a death sentence. Why buy and hold might be killing your portfolio. 1. The myth of forever stocks. The idea of holding a stock forever assumes that companies will continue to thrive indefinitely. But the reality is far from this rosy picture. Example: consider Kodak, once a titan of the photography industry. A buy and hold investor who held Kodak into the 2000s would have watched their portfolio plummet as the company failed to adapt to the digital age. What you can do: instead of blindly holding onto a stock, periodically re-evaluate its fundamentals. Is the company still competitive? Are its financials solid? 2. Ignoring market cycles. Markets don't move in a straight line. They operate in cycles, with periods of growth, decline, and stagnation. Buy and hold ignores these dynamics, often leaving investors exposed during downturns. Example: during the 2000 dot-com bubble burst, tech investors who held onto their stocks lost 78% of their value on average. The Nasdaq took 15 years to recover. The alternative: adopt a more active approach by setting stop-loss limits or reallocating funds during market corrections. 3. Opportunity cost. Every dollar tied up in a stagnant or underperforming stock is a dollar that could be earning better returns elsewhere. Example: if you had invested in Tesla during its meteoric rise but sold to hold on to your investment in a slow-growth utility stock, you'd have missed out on exponential gains. Action step: regularly evaluate whether your current holdings are the best use of your capital. A smarter approach: dynamic portfolio management. So, if buy and hold isn't the answer, what is? The key lies in adopting a dynamic approach that blends long-term conviction with short-term flexibility. 1. Set sell triggers. Don't fall in love with a stock. Instead, set predefined conditions under which you'll sell, whether it's a percentage gain, a loss limit, or a change in the company's fundamentals. Example: if a stock falls below a 20% trailing stop loss, automatically sell to protect your gains. 2. Diversify beyond stocks. Buy and hold investing often focuses exclusively on equities, but modern investors should explore other asset classes, such as real estate, bonds, or alternative investments like cryptocurrency or commodities. Pro tip: diversification isn't just about holding different stocks, it's about spreading your risk across asset classes that behave differently in varying market conditions. 3. Adopt a tactical asset allocation strategy. Tactical asset allocation involves adjusting your portfolio based on market conditions. During periods of economic uncertainty, you might shift towards safer assets like bonds or gold. Fact: research from BlackRock shows that tactical asset allocation can enhance returns while reducing risk compared to a static buy and hold portfolio. The role of technology in modern investing. One of the biggest reasons to question buy and hold is the rise of technology. Algorithms, AI-powered trading tools, and robo-advisors are changing the investing game. 1. AI-driven analysis. AI tools like Morningstar or YCharts can analyze market data and predict trends far more accurately than the average investor. Use these tools to identify opportunities and risks. 2. Real-time adjustments. Modern apps allow you to monitor your portfolio 24/7, making it easier to act when conditions change. But what about taxes and fees? One argument for buy and hold is that frequent trading can rack up taxes and fees, eating into your returns. While this is valid, modern investing platforms have reduced fees dramatically. Additionally, tax-efficient strategies like tax loss harvesting can offset capital gains. Closing thoughts. What's your take? So is buy and hold dead? Not necessarily. For some investors, especially those with little time or interest in active management, it's still a viable strategy. But for others, clinging to buy and hold dogma in today's fast-changing market could mean leaving significant money on the table, or worse, suffering unnecessary losses. What do you think? Are you ready to challenge the buy and hold philosophy, or do you swear by its principles? What strategies have worked for you? Share your thoughts in the comments below and join the conversation. Please like and subscribe.